The existing home sales market has spent the last 18 months with sales near Great Recession levels. But now that the Fed has finally given up on its COVID-era housing policy, it's time for housing sales in the U.S. to start growing again. The two big stories in the 2023 U.S. housing market were mortgage rates going up to 8% due to the Fed's rate hikes and inventory remaining way too low. All year, even with demand completely demolished by these high rates, there were still too many buyers chasing too few homes. Now in 2024, the Fed's rate hike cycle is officially over, and rates have already gone from 8% down to about 6.6%. In this video, I'm sharing my 2024 U.S. housing market predictions, including mortgage rates. My name is Michael. I own a local real estate brokerage here in the Dallas area, and if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below, or you can sign up for one of my weekly home buying webinars. That link is in the description below as well. Okay, let's start with mortgage rates. This year, I officially predict the 10-year yield is going to be much more stable now that the Fed is done with rate hikes. And my prediction is, as you can see here, we've already fallen back into this range, just this line to this line, and I gave some room for deviations, about 0.2% outside of this, but basically from about 4.25 on the high end to about 3.25 on the low end. And as you can see, we spent much of last year there, and I had drawn this last year. It's just these two lines translated to 6% and 7% rates. So as you can see, I've given room for deviations outside, so I believe this will translate to about 5.75 to 7.25% mortgage rates for the year. And again, a big part of this is going to be the stability, and we'll talk about why that's going to bring more listings later. But I do believe the year is going to look a lot like this, just fluctuating up and down. A few things that would change this prediction would be, one, if the labor market breaks. If unemployment rises significantly, then I believe we will drop below that 3.25 on the 10-year. And if that happens, we would go below 5% mortgage rates. However, as of right now, there are no signs of the labor market breaking. But if it does down the road, I believe that would lead to sub 5% mortgage rates. Number two would be the spreads on the 10 and 2-year yields improve. The spreads are historically bad right now. Ever since the big scare last year of banks running out of money, the spreads got much worse and they haven't really improved yet. Bad spreads are the result of economic uncertainty. So, as more economic certainty comes in, it's very likely that those spreads could improve. All you need to know about the spreads of the 10 and 2-year yield, on a basic level, they impact how much higher mortgage rates will be above the 10-year yield. So, one way you can see this is reflected on this chart, and this only goes up to March of 2020. I couldn't find anything more recent, but I'll show you another chart next. But the point is, this gray line is how much the 30-year mortgage is above the 10-year. And you can see historically, we're way down here around, it's less than 2%. I would say a lot of time it's closer to 1.5%, but let's call it 1.5% to 2%. So you can just see that reflected on the gray line. Here, it was as low as a little over 1%. Ever since COVID and beyond, we've gone as high as 3%. And I'd say we're still around that 3% now. So normally mortgage rates should be about 1.5% higher than the 10-year yield, and currently we're at about 3%. And you can see it reflected here in more recent data. So here on the low end of 2014, we were just below 3, and rates were at about 4.5. So again, about a 1.5% spread. But if we fast forward to now, we're at just below 5, I would say 4.75 compared to about 7.75. So still about a 3% spread. So if the spreads improve this year, that by itself could drop rates another 1% below my prediction. Maybe even more. So let's say the spreads go anywhere back to being normal, plus the 10-year gets anywhere near the bottom of my range, close to that 3.25 number, then we would have sub 5% mortgage rates just like that. So there are a few paths, not even crazy paths, that would get us to sub 5% mortgage rates next year. But for me, the most obvious range right now is 7.25 to 5.75% rates. And then of course, some quick math for those of you who don't know, if you want a lower rate, you can always buy down your mortgage rate. And for every 0.25% you want to buy down, it will cost you about 1% of the loan amount. So if you're at a 6% rate and you want to be at a 5.5% rate, that would cost you about 2% of the loan amount. So on a $500K loan, it would cost you about $10K, that's 2% of the loan amount, to get from a 6% rate down to a 5.5%. So keep that quick math in mind as you're shopping around and looking at rates this year. Also, you can have the seller pay that $10K to buy down your rate for you. And if you want to learn more about this, make sure and watch this video next. Now, let's move on to housing prices. If everything continues as it is and nothing breaks, I think we will see a similar continuation to last year with low single-digit gains for most of the country. The major factors that could change this are, one, if mortgage rates break below 5% in any of the ways we just discussed, this would bring too much demand into a market that already has too few houses as it is. And two, if people don't start listing their homes once again in 2024. As you know, many would-be sellers felt locked into their current homes because they wouldn't be able to afford their next home at a 7 or 8% rate. And the other part of this is that rates were simply moving too quickly to be able to make an educated decision. You may have listed your home when rates were at 7%, and by the time you got a contract, rates could be at 7.7%, and now you can't afford your next home. That uncertainty made it impossible for even the people who were willing to sell and buy at a 7%, because now, on top of the high cost, there's also a high risk, and this kept many people locked into their homes. So the hope is that rates stabilizing this year or continuing to drop will encourage more people to start listing their homes. In my opinion, rate stability is key to new listings data growing, and an increase in new listings is key to keep housing prices from skyrocketing again. On the flip side, however, if people don't start listing and we get the demand increase of not only the coming spring market, but also of rates dropping, then things could absolutely take off again with multiple offers and prices skyrocketing just as they did in 2021 and 22. So we really need people to start listing their homes again in 2024. Now, a little more about the economic outlook of 2024. We saw that in the Builders Confidence Survey that builders' confidence was starting to grow at the end of 2023. New construction sales are still going strong and will do even better as rates continue to drop, since builders are able to offer even lower rates than the resale market. In the entire country, there are only 78,000 single-family new construction homes completed and ready to sell, and they have another 106,000 homes that they haven't yet started construction on. And I wanted to show you by looking at this chart. That means we're about back in the range where we were before COVID. So here you have 2019, we were at mid 70s, as high as a little above 80, and right now we're at 78,000. So we're getting right back into the range that home builders like to be in. But builders will continue to manage their supply slowly. So there's not going to be this flood of new construction homes coming onto the market and dropping prices due to too much inventory. Remember, there are 78,000 new construction homes available for a country of 330 million people. Builders can sit on these lots as long as they need to and are very good at pacing their sales. They're going to build at exactly the pace that will continue making them the most money while keeping their prices as high as possible. You've also been hearing people say recession all year long. It never happened. GDP continued to grow, inflation continued to drop, and the jobs market and employment remained strong. Until jobless claims break over 323,000 on the 4-week moving average, we won't even begin to discuss a recession. As you can see here, we are in the low 200s and nowhere near 323 with no signs of growing. So we're nowhere near a job loss recession. The reality is the US economy is still looking very strong. So in summary, I don't believe prices will be coming down, and I never suggest trying to time the market based on mortgage rates or housing prices. You have no idea when or if they'll actually drop. As I always say, make the best decision with the one factor you have control over, which is your monthly payment. Find the monthly payment you can afford today with the amount of cash that you have today, and buy whatever that will afford and just enjoy it. Over time, you will not regret it. On the other side, everyone who has tried to wait and time this market so far has lost money, either because rates have gone up or prices have gone up. Please don't try to time the market. I'm sure you've all heard the saying, it's not about timing the market, it's about time in the market. Okay, that's my prediction. Starting next Monday, I'll be back to doing my regular weekly market updates here in Dallas. And as always, if you're looking to buy or sell in Dallas, call, text, or shoot me an email. I'd love to connect. All that is in the description below. Thank you for watching, and I'll see you in the next video.